Ladies and gentlemen, please let's settle down as we continue with today's proceedings. All right, good afternoon once more. My name is Bubosi Mashele and I am your MC for today's proceedings to give a presentation on key issues that have impacted the oil and gas sector in Congo historically, COVID, energy transition, and of course geopolitics. We have Lucinda Ross, who is the technical research analyst at S&P Global Commodity Insights. The title of her presentation is Navigating the Change in Upstream Sector, a Congo Case Study. Ladies and gentlemen, please let's give it up for Lucinda Ross.
Good afternoon. Yeah, I will say, come closer. So we can have a nice intimate little session. The few of us that are here. Good afternoon, everybody. My name is Lucinda Ross, and I'm a senior research analyst for the upstream sector in Africa at S&P Global Commodity Insights. Today I'm going to be taking you through a case study on Congo. So being a research analyst, there is a lot of data in the presentation, but hopefully I'll be able to take you through a story of Congo. So, Congo is a mature oil exporter with a number of international oil companies actively present in the country. It is the sixth largest producer in Africa currently. This is after our top five. Congo is then next in line. In 2023, the petroleum sector of Congo accounted for 25% of the GDP, 2/3 of the fiscal revenue, and over 80% of the export revenue of the country. And this is actually in fact lower than what it had been historical. So if we look at 10-year average figures, they're significantly higher at 55% of the GDP and up to 80% of the fiscal revenue attributed to the sector. So the diagram that I then have there just shows you the current status of the upstream sector in Congo, and we can see where the operators and which operators have which blocks. The top right map is then a slightly different view looking at the competitive landscape. And the pie chart then breaks down the production of the country into who owns the production looking for the 2023 production. So in terms of acreage of the currently producing assets, Total Energies operates the ultra deep water blocks, which is the pink block that you can see there. One of these includes the Marine 20 block with the recent Nyomo exploration well, which we unfortunately did not encounter hydrocarbons, but it's exciting for potential exploration in the area. They also operate the biggest producing asset in Congo, the Mo Belondo and Mo North developments, and Chevron is also a partner in this asset. In 2023, this asset contributed to almost 35% of Congo's total production. So another player is ENI, who operates a large acreage, and this includes the Marine 12 block, where the first FLNG development came on stream at the end of 2023, and this officially made Congo an LNG exporter. As part of their portfolio rationalization, ENI also have sold a number of the oil assets because they have taken a strategic decision to focus on the gas. But this also meant that Perenco now has a considerable number of operated acreage and one of their share in the production of the country. Another company which is worthwhile to note, they only operate currently the little brown block over there is China's Wingwa. But they are very active in their drilling, and they are looking to, you can see them in the pie chart in terms of the production of the country, making a significant contribution, and this is expected to increase even further. So, now this is where we are currently, but let's go back in time and just have a look at the production history, the history of the country. So this is looking at the number of new field well-cut wells that have been drilled in the country. And you can see that in the 1980s to 1990s, there was considerable exploration taking place. And this resulted in a significant increase in the reserves of the country to around 4 billion barrels of oil. However, in 2015, the oil price caused a significant reduction in exploration, and Congo has never recovered from this. The only exploration well that has been drilled in this year was Total Energies' Deepwater Nyama well. And the only upcoming exploration well is New Age's KFM well, which is looking to potentially expand the Nene Marine discovery. So exploration is key in order to sustain production and replenish the reserves of a country. And this declining trend in exploration will have a direct impact on the production. But now, I just also at this stage like to highlight the two assets. I've got the little block there. So the most recent discoveries that actually added a significant resources to the country were Nene Marine and Bangakayo in 2012 and 2013 respectively. And they increased the reserves base by around 15%. And so they had a significant impact on the production of the country, which we'll look at in more detail on the next slide. Okay, so this slide is a little bit busy, but it kind of shows you an overall trend of the historical production in the country. And this shows an increasing trend in production. So back to Nene Marine and Bangakayo. They were made during a period in time where the Brent oil price was over $100 per barrel. And this is depicted on the plot here with the red line. And so when they were being de-risked, the projects would have benefited from this high Brent price, and they would have had optimistic economics run. And as a result of this, these projects were both brought on stream within 3 years of discovery. However, in 2016 on the graph, Congo brought in the 2016 hydrocarbon code. And ultimately this code resulted in a tightening of the fiscal terms for potential investors. But it also provided clarity and reduced ambiguity for the investors when investing in the country. So the fiscal terms in Congo have always been and remain negotiable. However, the 2016 terms reduced flexibility compared to the 1994 terms when it came to negotiation, as they included more presets, such as the minimum state participation of 15%, and a minimum profit share for all oil for the state of 35%, that now need to be taken into consideration during the negotiations. There was then a 2018 model contract which included a stabilization clause, and this then was positive for potential investors because it provided some stability. Long-standing investors such as Total Energies and ENI, however, benefit from foundation agreements which offer tax breaks and incentives, which is likely a strong contributing factor to their sustained presence in the country. More recently, Congo has been very public about being negotiable on contract terms in order to promote upstream investment and prevent the production from declining. Given the current focus and shift towards gas, clearer terms are more likely to be introduced, as the current PSCs do not provide clear domestic market obligations or pricing for gas. And in fact, at a panel earlier this week, Congo has said that they're in the process of developing the gas master plan, and part of this will include new legislation for the gas developments. We can also see on this production graph that there are a number of peaks, and these peaks are caused by new projects coming on stream. And this again just highlights the importance of conducting exploration in order to create these peaks and sustain production. So The Moa Belondo and Moa North asset increased the production by over 30% in 2010 when Moa Belondo came on stream, and then in 2018 when Moa North came on stream, it increased by a further 50%. Okay, now the little orange sliver on top of this graph is now our gas production of the country. So we can see here that gas production has been very low historically, with gas having been flared or re-injected previously. However, in 2002, gas from Kitina Marine was first used for domestic power generation, and subsequently there have been a few other fields such as Mbundi and Lichinjili, which have also been used for domestic power. And then you can see now, like we had for the Brent price of oil, we have a gas price down at the bottom in dark blue, which is your MBF gas price. And in 2022, there was a spike in our gas price benchmarks, and this was due to the Russia-Ukraine conflict. And this resulted in improved economics of potential gas projects, which previously had been classified as uneconomic to develop. In addition, there was a move towards gas being a transition fuel for companies who had targets for net zero emissions. In response to this shift, ENI was able to fast-track their gas development of the Nene Marine field by utilizing a smaller pre-existing FLNG vessel in a phased approach in order to commercialize the gas that they had previously been re-injecting. ENI's ability to be agile and shift their strategy quickly, as well as to plan ahead for multiple development scenarios, meant that they were able to achieve first production only 1 year after taking FID on the project. So overall, in terms of production, there's been an increasing trend in both the oil and gas production of the country. But for how long is this likely to continue? So in order to get a better understanding for this, we're going to go now and have a look at our forecasts for the country. Right, there we go. Okay, so on the left I have the oil production forecast, and on the right are the gas production forecasts. And you could see the difference in the previous slide, so the scales are not the same. So the short-term outlook for oil production looks very positive, with production expected to increase to over 400,000 barrels within the next 5 years, which is in line with the country's target that they have been saying of 500,000 barrels per day. This increase is relatively certain to go ahead, as it includes two big projects which have already taken FID, namely Total Energies Moa Belondo development, which already has a contract for wellheads signed, which will be delivered in 2025, as well as then ENI's phase 2 of their Marine 12 FLNG development. And that ENI is saying that it's slightly ahead of schedule and it's expected online next year. The development of the Harmony structure is, although unsanctioned on this plot, is also looking fairly certain, with sources indicating that there are positive indications for the development. However, from 2030, the production indicates a rapid decline, especially if the unsanctioned projects do not take FID. Additional investment is therefore critical for Congo to sustain the oil productions past 2030. In terms of the gas production of Congo, so it's relatively new exporter of gas, with the first gas exports only taking place at the beginning of this year. This has resulted, however, the FLNG development has resulted in a doubling of the commercial gas production of the country in 2024. And another asset which is due online in the next gas asset due online shortly is the Bangakayo gas development, and which is planning on providing domestic gas or alternatively regionally. So this shows a relatively positive picture for the gas story of Congo. However, Congo clearly is aiming to increase their gas production in the country with their gas master plan. And in order to achieve this, exploration is required in order to identify additional projects which can be brought on stream. Okay, shifting now back to our gas story. We can see we have done an economic analysis of all the current and upcoming oil projects in the country. So the plot on the left, the dark blue projects are the currently existing projects that are producing. And they all show relatively healthy economics, with break-even oil prices below $40 per barrel and below, and positive NPVs. The sanctioned oil projects, which are orange circles and are expected online in the next 2 years, also show good economics, and with commercialization of the Lucinda oil dominating. That is a large red-orange circle. And this is due to the fact that there is existing infrastructure already in place from the Nene Marine field, and that there is a large volume of recoverable resources associated with it. On the other hand now, if we look at our unsanctioned projects, which have not yet taken FID, we see a spread in the economics. So those are our open circles. And around half of the projects have poor economics. So the plot on the right then has a closer look at these unsanctioned projects to try and see why there is such a spread. So we have color-coded that plot to show your onshore assets in blue, and as well as in shallow water and deep water, as well as looking at the development concepts, whether they are near existing infrastructure and can be a simple tieback or require standalone development. And this plot just shows how these factors all play a critical role in determining the economic feasibility of a project, because deep water projects increase the cost significantly and make it much more challenging to develop. So one of the assets I'd like to highlight is you can see a big green circle with recoverable that is sitting in a very negative place. And this is the MTPS asset in Congo. Okay. But we will get back to him at a later point. So we then did a ranking of our unsanctioned projects, and here again the same color coding has been used as in the previous slide, and the onshore projects generally have lower costs, resulting in the better economic compared to the offshore projects where development costs increase, and you can see that by the bars, and the resource size and proximity to infrastructure becomes critical. From the pool of unsanctioned projects, around half of them have 20 million barrels or less of oil recoverable, and only 2 of our projects have more than 100 million barrels oil recoverable. And these 2 projects have significantly different economics. The Hormone structure is an onshore asset and has been modeled as a simple tieback due to the existing infrastructure, and this makes it economically attractive. And on the bubble plot on the previous slide, we can see that it almost lay on top of the economics of our existing projects. Conversely, the MTPS asset is around 3 times the size of the Hormone structure, but has poor economics. With an and this analysis has been done with an oil price of around $60 per barrel, which is in line with what companies are currently using. And the results of this analysis is due to the location of this asset. It is an ultra-deep water and is isolated, so it would require specialized drilling and standalone development, which results in the high development costs. Now, looking at this and the large volumes associated with it, and that what would be required in order to make this asset economically positive for potential investors. So I ran it through a fiscal analysis, looking at, firstly, if we now go from we're going to go from the bottom to the top of this graph. So we've got Congo PSA down at the bottom, and then above it we've got a couple of its peers, Equatorial Guinea and Cameroon, and we can see that we have relatively similar economics to these countries, which are our peers. However, at the top, although not directly comparable to the industry in Congo, I've included Namibia and Angola terms, more to illustrate what countries are doing who are trying to increase exploration in deep water blocks. The marginal terms of Angola indicate how the terms can be changed from the PSA terms to the module terms in order to improve the economics of projects that are challenging. Compared to other fiscal terms, the Congo terms also show quite a large spread when being looked at between the high and low price. And this is due to the fact that their terms are no longer based on cumulative production, but rather use flat percentages. And this does simplify the contract terms for investors so they are clearer and understand what they're getting into. But it also means that the fiscal regime is not doing any work to actually shield the investors from the downside scenario. And on the flip side, it means that in an upside scenario, the government isn't getting the benefit that it could get. We look at the graph on the right, it shows the breakdown of the revenue paid to the government. And this also then illustrates how both Congo and Equatorial Guinea have high government takes compared to other countries of around 70 to 80%, whereas Cameroon and Gabon are more in the region of 50 to 60%. So this analysis indicates that Congo, although negotiable and publicly negotiable on their terms, Congo may benefit from adding some incentives for deep water projects to their fiscal terms, perhaps increasing the complexity slightly, but it would allow investors to understand upfront what incentives the government are willing to take when it comes to deep water exploration. And these could include things such as tax exoneration for deep water developments, potentially reducing the government's profit share below the threshold of 35%. Okay, so that is the story of the oil. And we're going to now just have a quick look at the gas. So, we can see that on the gas side, we are requiring exploration. We need more gas projects so that we can make this graph busier. But if we look at the current projects that we have the Marine 12 FLNG development, and these have relatively high break-even gas price of around $6 per 1,000 cubic feet. However, due to the nature of the development, because Eni sells the LNG on the European spot market, the project is still economic with high NPVs. We then look at the Bangukayo gas development, which is the orange circle closer to your axis, and this has significantly lower costs, being an onshore tieback facility. But the economics are not as high as Nenarine because the gas is going to be sold on the domestic market, or else alternatively, if there is excess, they have said they'll sell it regionally. However, Congo is in the process of developing the fiscal terms for gas specifically, and this will hopefully improve the economics for the gas projects in Congo and attract the investment that is so needed. So we can see this again explained on the right-hand chart. Our currently producing projects at the top have positive economics, and as well as the Bangukayo onshore asset also. Our Nena Marine then lies in the middle there of the bars with high costs but still strong economics given the market. And our offshore unsanctioned projects are sitting down at the bottom where they are very difficult under the current legislation to monetize and make them economically attractive for development. So, in conclusion, I have provided this slide. And this slide shows all the prospects in Congo. And this just shows the large potential that exists. And this is especially true if we look in the deep water acreage, which is currently unlicensed. We need to ideally go and increase new field wildcat exploration. We need to go and put a well in every one of those prospects to turn them into discoveries and increase our project pipeline for the country. But in order to achieve this, we need to attract the investors, and they need to be incentivized to drill in Congo. And in order to do this, the Congo needs to continue working on their fiscal regimes, and as they have been doing. In the panel yesterday, Trident Energy says They enjoy working with the Congo government. They need to continue in this trajectory so that they can increase exploration, which will result in additional discoveries, expanding their asset portfolio of the country and unlocking this untapped potential. Thank you very much.